is every day I take a look at where we are in the market. And so where we are in the market is basically I look at what the SPY is the top 500 companies, and they trade under this one ticker, and we try to see what is going on there. And I use two metrics, one called the 5-day EMA, and the other one is called the 13-day EMA. Now, I use that specific to the SPY. With the QQQ, which is the NASDAQ, I use the 918. And let me show you where it is. This is stock charts. All it is an exponential moving average versus a 5-day exponential moving average. And what does that mean? What that means is that we're going to look at the last 5 days closing price of each one of these. Each one of those, they're called candlesticks. Each one of those represents the move of the day, the high, the low, what the volume was, as you can see there. And so the 5-day exponential moving average is going to look at the last 5 days of closings. So you see the C there, it says 385.13. That's the closing price. The previous day the closing price was 377.91. And what they do is they just take an average of the last 5 days. And it's exponential. Exponential means that we're going to overweight the previous one. And I think the numbers are on 40%. And then this one's like 30%. I don't remember exactly the formula. But basically, one goes 5 days, the other one goes 13 days. And then we come up with these two lines. One is a teal line and one is a purple line. I just deemed them that way. And so the idea is that once there's a crossover, I know we've reviewed this, but we've done this before, but I'm reviewing. So the idea is that if the 5 day is above the 13-day, then we're going to take a more bullish approach, which means we expect the stocks to go up. If the 5 days below the 13-day, we're going to take a more bearish approach. Okay, so that's basically that part, and you just have to have that logged in the back of your mind in order for you to just feel comfortable with what you're trading, what you're looking at, what you're doing, and it's kind of like leaning. It doesn't mean that things are going down just because the 5 days is below 13-day. You can see we've been below 1, 2, 3 days, and all those days have been up days. And same here, we did rise up at some point and we crossed over, and then we were low, but here we lost on this day, July 11th, and it came down. So that's about it. Now I'm going to change here for a second. And as far as day trading is concerned and trading in general, day trading doesn't mean that you got to get out of your trades the same day. You can keep them a few days, a few weeks. But overall, like generally right now, it's been something that is very necessary to trade in and out this day of. I'm going to show you my favorite technique that I've been using now in order to day trade. And so here we have, let's just take a look at SPY. And we're going to look at this on a daily. I basically use the 5-minute candles. So each one of these candles is going to have, let's switch to something that's easier to see. It's triple trend. Triple trend is another one I'm going to show you, but what I'm going to show you now will complement that. All right. So each one of these candles is a 5-minute candle. And so what we're looking at here is basically the movement that happened on, oh, thank you. We're going to go to SPY. That happened on Friday. So you can see, and there's after hours. So the SPY is basically where you can trade from usually 9:30 to 4 o'clock. Now they have pre-market times. They have extended times. You can trade it actually from like 7 in the morning all the way to 8 o'clock at night, but there's just not a lot of volume. The counterpart to the SPY It's called the ES. The ES is a futures product, and futures trades 24 hours a day, except on Eastern Standard Time from 5:30 to 6 o'clock. And so in order to track the SPY overnight, because basically, and it's not like 100%, but it's like 99% correlated, that whatever the ES does overnight, the SPY will mimic and will track. So the SPY, you see a start up on the day, it's because overnight the futures market went up. And so, and there's other countries that trade during that time, Asia and England, they trade at other times, and they're using the ES and to trade. So we're going to turn that on. So the trading methodology I'm going to teach you right now is that we don't start trading till after an hour has passed from the open. And why is that? Well, the first hour is really crazy. Like the movement of the candles go absolutely haywire. And so it's one of those things that is really hard to trade. I'm going to show you another strategy that could be used during that trade time. And this strategy I'm showing you, I'm going to give you the exceptions as to if you were up and you saw it moving during the time when you would trade it. So the short of it is, when I open up the computer, what I do is I look at what happened from 6 o'clock the previous day all the way until the time that I take a look at the computer. And what I'm looking at is what was the high price and what was the low price. That's it. So as an example here, you can see that the high price, actually that the low price was right around here, 38.21, and that happened at 9:40 in the morning. In fact, that there's actually a lower price. I see it now. There we go. 37.94. Okay. So 37.94, you jot that down, and then you look at the high price. The high price looks like it was over here at 38.67. So you write those two numbers down. And what I do is that I set an alert on Thinkorswim. So setting an alert on Thinkorswim allows me to walk away from the computer and not be engaged in it all the time. I get a text to my cell phone, and then or an email, and then I walk to the computer when the prices get close to that number. So I have ES on all day, but when I go trade, I'm going to show you that part. But when I go trade, I trade the SPY, and there's reason behind that. You can't just trade the stock. I trade options. We're going to go in depth into options at a later one, but I'm going to kind of gloss over that. Options is basically a contract. One contract represents 100 shares that you lease, that you rent for a time period. And usually you set a strike price, which is like, if the SPY was at 388, you can get a strike pretty much anywhere from there. And we trade the SPY because it's super liquid. It's one of the most liquid instruments there are, which means you can get in and out of positions like very quickly. So it's a really, really big win for you. It's one of those things that makes it really amazing to us as far as doing trades and getting in and out quickly and not getting a crazy price. Now, there's other instruments I'll trade. Specifically, if I have very, very high conviction, like for example, NVIDIA, I like trading that a lot because whatever the QQQs, which is a different version of the SPY, is moving, the NVIDIA will sometimes do 1.5 to 2 times the move, which means you can make more money, but you can also lose more money. So we're going to go over risk management extensively in another lecture. And so, but right now I'm just going to focus on the strategy and how it works. So we talked about the high and the low. We set the alarm. And so let's assume that the alarm is getting close, and we set it around here, 38.64, and our high price is 38.66. So then at that point, I'm thinking, okay, we've had a ranging day. That means it's been going up and down. And so we would anticipate to hit the high price and go low. Okay. So why would I anticipate that? Let me step back a second and let's talk about what the market is. The market is driven by institutions that have billions and billions and billions of dollars to trade. Clients and governments give them money in order for them to create a return for them. And so when you have that much money, there's only at certain prices that you can trade. So these institutions, we'll call them hedge funds, these hedge funds are always looking for liquidity. They're looking to see where buyers are set up. Okay, these are called money zones. I call them money zones. The money line zone, basically what it does is that the prices will tend to move, to gravitate towards those prices. And so why do we select the high and the low range? Well, the high and the low range happens to be areas that the hedge funds have deemed um, liquidity areas. Okay, so there's orders there. There's orders waiting. The rest of the game that gets played in between, and look, there's various little mini zones in between. I'm not teaching that today. There's some areas in between that you can play. We can go into that in depth if you ask me privately. Just because then this would get too long. But the idea here is that what you can do is set the price, and they basically do a nice giveaway to you where they show you, hey, this is the price that we're going to play from, and the high price and the low price. And so you play either breakouts or a bounce down. Usually I want to say 60 to 70% of the time, when you see a high price, we'll see a bounce down toward the bottom part of the range. If you see a low price, we're going to see a bounce up. Now, there are breakouts. There are times that we go way above our price. And at that point, we have to be on our toes, like always, right? And trade that price. So as an example here, what we would do is, if we see this happening as you see it now, we would anticipate this going down. And so here you can short the SPY. What's the short of the SPY? There's a symbol called SH. Now that's a 1-to-1. So for every percentage point that it goes down, every half percentage point, your account will gain that half percentage point on SH. Now, it's a very slow way to trade. When you do day trading, you're expecting really big returns. And so what's an alternative to SH is SPXS. So S, that's ticker symbol, SPXS. What it does is that it multiplies the downside by 3. So if the market loses 1%, the SPXS will go up 3%. Okay. So again, if the market loses 1% with SPXS, and when I say market, SPY, SPXS will go up 3%. This is a really good day trading vehicle. You don't have to do options. All you got to know is that you could also lose 3 times. So if the thing turns around on you, then you're losing 3 times your money. So it's an excellent vehicle to use. I use it often. What I use are options. So an options contract, 1 share, 1 contract represents 100 shares of the instrument you're trading, the SPY. So basically the SPY is currently, let's check it out. The SPY is currently at 385.20, for example, 385.20. So 100 shares of that represents $38,520. Now, if you can trade that, you can trade that. But if you're only going to hold the position for, say, 2 hours, there's no need to put in $38,000 in there. You can buy 1 contract, right? And that means you're leasing the $38,000 for a fraction of that cost. And so let me show you what that looks like. Let me share the screen. And so this is my trading platform. This is the setup that I use to day trade. I am on my laptop. When I'm on my desktop, it gets way more complicated. I try to keep it as simple as possible when I'm trading. So we're not seeing this come up over here. Let's prompt it with the yes. Yeah, yes might be able to show us a little bit better. Okay, so as you can see here, this is where I go in, I choose options, and I'm going to choose the SPY, and the SPY shows up. I'm going to choose it, and it's going to give me these decisions. There's an 18th July, 20th July. What this means is that you can rent one contract right here is showing 1.42. Every one of these numbers you multiply times 100. Okay, so that's $142.50. You can rent it for $142.50. You can basically own, right, 100 shares of SPY for $142.50. But that will expire. You holding that, you renting that will expire in July 18th. So that's tomorrow. Okay. So you can actually buy it in the morning, and at 4 o'clock is when it expires. It's super aggressive trading. You can do that. But if you're only going to hold 10 minutes, an hour to 2 hours, then it's okay to hold that, right? But you better know that you're going to get out no matter what. If you're down or up, you're going to get out before the day is over. In fact, you should get out within 30 minutes to an hour after you invested that instrument. So I don't know why this isn't coming up. Oh, I know why. This always does this to me. Because it's not today. Let's give it 5 days. Okay. So this is the SPY 5 days. Let's do the ES 5 days. So again, I'm looking at ES, which is the futures market, but I'm trading the SPY contracts. Okay. So we go with the high low. Notice how this just puts it in for me, but this is way more than a day, right? This isn't just Friday. This low number is just Friday. To me, that's no longer relevant if you're day trading. The relevant times start at 6 o'clock, right there, right? And so there's a low point here and there's a high point here. And they're the two numbers that we talked about. So I just set an alarm just to show you how that works. You right click, you say create alarm, single. This is our at or above, which means it's crossing the line at or above. And I just say mark. And I'm going to create it here so you can see how that gets created. And that's my mark. So now, oh, it's at or above. Yeah, it's currently at or above. So it already issued the call. So let's put this one in here. Let's put the low mark because that hasn't triggered. That one just triggered, by the way. Okay, so this one is at or below. So you can see it marks it, right? So what'll happen is when the price gets close to that, it's going to tell me, hey, price is close to that. And then I come to my computer, I get a text, and I come take a look at it to see what's going on. So that's it. So now what do I do? All right, well, it gets a little complicated here, right? Because now the question is, how do you enter? There's a lot of different ways to enter a trade. But the key is, if the thing goes past the area, so let's say you enter this trade, okay, this is good. Let's say this was the high point. Notice that's 145. We're doing a hypothetical here, okay? So let's say that this was the high point and you thought that this was going to go down, and you're right at first. I'll teach you how to take profits as you go, right? Usually what you want to do, and let's do it right now. So when you enter a trade with options, I'm going to talk strictly options right now, is that once you get about a 10% return on your investment, so I showed you that that was $142.50 on that one, then what you would do is I usually trade minimum 4 contracts. Sometimes it's 10 contracts, 20 contracts, 40 contracts. So, but with the minimum 4, what we'll do is once we get to 10%, I'm going to cut 50% of my holdings. Okay, and so what does that do? Well, that already gave me a gain. And for these contracts, it'd be like 28 bucks, which isn't a lot, but this is the way it works. Risk management is very important. Then my stops, which means how do I know when to get out? Here, when a candle closes above here, when a candle closes above here, one of this is a closed candle. Like this candle closed above here, right? We have to get out. Now this candle made you lose a lot of money, right? If this candle, let's say you enter this trade right here, and then this candle appears and it comes out here, you lost a lot of money. That's a big loss. But I'm going to show you. You look at the zone, you look at the money line, the 5 minute, and then you switch it to 1 minute. And so you wouldn't get that loss as we saw it. Oh, it's doing that thing. Custom time frame. Not just today. We're going 5 days. And so here we go. So this is where this happened, right? Notice our entry point was right around here. And in fact, we lost money at the closing right here. So you would have gotten out here and you wouldn't have lost here. See that? Let's go back to our 5 minutes so we can finish. But I'm just wanted to clear that up, how that works. Like you switch it to one minute after you're with the 5 minutes. So you set your alarm at 5 minutes and then you use the 1 minute to enter. But how do we do that? All right, so we're right here. This is the one we were talking about. So you're looking at this 5 minute bar and you're like, it's right on my line. It's just holding. I think it's coming down. Okay, good deal. So I'm going to teach you a couple of the candles that you should have memorized when it enters the zone line. Once it enters the line of the price that you looked at, you're looking at a couple of these. The first one is, this is called doji. Whenever you see a cross, that usually means a reversal. It tends to be a good time to get in, but I don't get in on that candle. I get in on the next candle and I make sure that it's already hidden the way that I want it to go. So we're at the top. It's been hanging around. We got a hammer candle, which is another one, but this one, it happened right away. This one went the way we wanted to, and you could enter here and you'd be all the way in here and then finally flush. Let's say you turn on your computer and all you see is the doji. The doji, the next one starts down. That's when you enter. And so look, you're winning this trade, you're winning this trade. And now once you're in a trade, you could start looking for more dojis. This reverses, you could get out right here. If you're feeling, just so you know, this move from here to here, from here to here, that should produce like 30 to 40% return on the investments that you have. So it's a really nice win for you. It really does well for you. So that's why I like trading with the options and very quickly, because you can make a lot of money and be in and out. So right here, we probably around here, we're at like 10, 15% gain. So here's the exercise that I do. Let's say I'm in here, then I'm going to take at like 8 to 10% return. I take 50% up. My stop loss is no longer way up here. My stop loss is at what I entered it. So here on this example, we're using the 142.50, right? So now my stop loss is no longer, it's usually like a 20, 25% on the downside. My stop loss comes down to, or actually comes up to my entry price, which means now we have a guaranteed win. So we got out of 50% of our holdings and we move our stop loss to our entry price. I'll show you how to do that later. I'm just commenting on the process here. And so then the next one is like the 16 to 18% gain. 16 to 18% gain, you take another 25% off of your holdings. And so you're down to 25% of your holdings. That one, you can either leave the stop of the stop loss or do a trail stop. The trail stop could be anything as long as it's not lower than your entry stop. There's different ways to do it. One of my favorite ways is I just do a percentage of the move. So, you know, if the move has been, you know, 40 cents, then I'm going to do about a 25% trail stop, 10 cents. What is a trail stop? A trail stop means this. let's say we're at $200. So we are at 142.50. Let's say we're at $200. That by the time we were gonna get out, there's probably like a 20-cent room. So if it gets to $220, right, or that 220, and then it fluctuates and it drops below $200, we'll get executed out. But if it doesn't do that, if it drops down a little bit and it continues up and it gets to say 250, and then it drops to 220, sorry, 230, then that 20-cent trail stop will trigger other loss and then we win. So as you can see, that process is a little complicated. I'll have to do like a separate class to show exactly how that works. So perhaps I could do that here. Actually, let me try that real quick. So this site that you're seeing is called Thinkorswim. Thinkorswim is awesome because I'm going to show you how to practice. There's a button here called On Demand, and it'll take us to pretty much any day that we want, I think, over the last 7 years to trade. All right, so this is July 16th here. Let's change that date. This is July 16, 2025. This is a good day. So let me show you real quickly how to enter the trades and how to exit. I'm not going to, it's pre-buffering right now. You know, I'm not going to be, I'm just going to enter a trade. Like, don't think this is how I actually trade, but look, there's a high and there's a low and we're close to the low. For those of you that are curious, this purple line is called the volume weighted adjusted price, and it's bouncing. So what I would do here is practice. Notice it's saying December 16th, so it hasn't caught up to itself, right? So unfortunately, I already know what happened in that time period, but that's why I go way further back to 2022. Let's see if it updates, because it's showing December 22. I just really wanted to show you how to do that trade. Anyway, it looks like basically July 16th up here, 2020, and we think we're going to do calls. I'm here on, this is a practice mode. So what I would do is 1,878. We're never trading that type of stuff. We're trading other things. So here you can just say how many you're buying. 5, and then you would say, okay, buy, and then you buy, and then it'll come up, and then you would get out here doing the sell. Now this is, it's not doing what it needs to do at this point. Okay, I gave you a lot. And so let's pause for a moment and let's talk a little bit about why day trading is difficult. Okay, God created us in a way where we're wired to be fearful, not fearful, but to react in certain ways when we have a certain perspective. And so the market has been perfectly set up to trigger certain emotions to get you to act in a certain way. And so you almost have to run counter to that feeling every now and then. And the only way to do that is through planning. I also, what I do is I pray before the day opens so that I have a clear mind, so that I, to glorify God in the ways that I'm going to trade and how, keep my emotions level. And because whenever you're in a big trade, your emotions kick in. So day trading happens to be, I think, 70 to 80% mental. Yeah, 70 to 80% mental. Why? Because you could have made the right decision. You could have entered the trade properly. But because these candles, as you can see how they move, right? Up and down, up and down. So let's say you entered this trade here, right? You entered here and now it's going down. If you're in heavy, you might say, oh, I'm out this trade. Like, I have to get out this trade. This is hurting my feelings. Now, the cool thing about this is that you can speed it up 3 times. Things will be, notice these candles, how they form, they go up and down. Right now, if we were in this trade, we right now would be up a little bit, as you can see, because we would enter calls right here to go to the top side. Call means up, put means down. So call up, put down, memorize that. Now look, it's coming down. But see, you have to have the wherewithal to be like, oh, I can't get out right now because it hasn't hit my stop, right? If it hits my stop, then okay, I'm out. I lost that game. And so the idea is that you're never going to win 100% of your trades. You should aim for a healthy win rate. More importantly, you should aim for a healthy average win that should be way bigger. And the number for me is 2.5 times bigger than your average loss. So for every dollar you lose, you should be winning $2.50. Okay. And you can only accomplish that. Only way you can accomplish that is through discipline. So the formula is number of shares times the, not sorry, win percentage times average win minus, oh, this is great that you saw that. You saw that candle, right? It was triggered. It was trying to trigger you to get out of this play. And it's now green. See that? Now these are 5-minute candles. And now it's going up. In fact, had we entered this trade here, we would be winning about 10 to 15% right now. Okay, so this is a really good example. I wish we would have traded it, because then you would have seen that happening and me clicking off and going from there. But overall is that the equation is your average win times your percent win minus your average loss times your one minus your percentage loss. Okay, if you can control that, you can make money trading. And I know I've only shown you one strategy, but this is a very powerful strategy. That the same idea will work for you if you extend the time. Okay, so you take the high low. If you're going to do daily trades, let's go back to that. This is important. Let's go back to that. If you are going to daily, use daily, then instead of using 5-minute candles, you go to daily candles. Okay. And so what you do is you look at the last, some people use 30 days. I use 2 weeks. Some people use a week. I think that's too soon. So you look at the last 2 weeks, the high and the low. So this is July 15th. Let's say July 1st. So right around here, you look at the high and you look at the low. You see that range. We are in no man's land right now, so you wouldn't do any trading. What you would do is you would wait to see what happens here, right? If it's going to hit up here, is it going to continue up or is it going to come down? And your stop loss would be right above it. Now, if you're going to do day trading, probably better to do actual stock, right? Actual SPY. You can go with options. It's just while the big red numbers start showing up when you're doing daily trades, but you can trade out further out. And without getting into it, that's just more intrinsic intrinsic value. Okay, so that's strategy number one. All right, strategy number two. I'm strategy. Strategy number two. Gosh, if you were in person, we're in person, I can ask you. So I'm just going to pick out of the air, since I'm seeing right now this triple trend strategy. Use it a ton. Okay, but it is quite much better in faster time. Let me show you because in a second. If you're trading overnight, this is only trade futures at that point. If you're showing you those prices, the internet slow down. Okay, so we're here. Back in time. Let me show this real quick. Does not. An indicator called the Atr Trail Stop, and then let's turn this simple moving average, and I use the 21. And so, how would you trade it? 3 to be showing us positive. First, the price activity to trade the Q sticker that we see it. That's going against the negative point is right here. If this closes here, and as long as moving average is below here, we'd probably be forced to get out, but it's above the ATR trailing stop. So then you could stay in. So it's a pretty difficult trade to get in and execute, just because it has varying and moving targets. So it just makes it quite difficult. It's much better with even more volatile. NQ tends to be on is basically it makes our life easier. So this is oil. So you can see here, and we could stay in and we would win this trade, right? So we could enter right here as this crossing here or below this point. We might want to get out here. This is a trigger, but the Q stick is still down and we're below here. So we could give it a little leeway and then we get rewarded. You might push this out too. This would be tough to stay, but we've won this trade if we get out right around here. But if we stay longer, we are rewarded. So that's the triple trend. I think it's one of those things that it's a good tool to have. It's not my favorite, but I do use it. This is really good between 9:30 and 10:30 and overnight. Overnight is better if you want to be able to trade, because we can't do the high low. You can use that, but the problem is that the hedge funds aren't, like, they're still working out their strategies for the day. Okay, so I'm going to leave you early today just because the internet is not amazing. I think we're going to have to revisit this. I hope you guys are done well. I'll close with a prayer. Thank you, Lord, for this time. Let us learn these trading strategies and risk management. They are designed to create very, very quick growth. And we understand that the trading, the mental aspects are very difficult. So we will fill out more of this trading strategy on the next session.